Hey everybody, Boris Slash from BK Forex. Welcome to our Forex Weekly Technicals for 2/10/2/15 of 2014, bucking the trend. Well, I think the picture is pretty much clear as mud right now. The NFP numbers came in, weren't nearly as bad as, so bad that the market thinks the taper is off, but weren't so good that the dollar got any kind of a boost. As a matter of fact, the euro had a knee-jerk reaction up, came back down, kind of made its way back up. Euro, I think in many ways, kind of interesting trade because it got a big boost this week from the fact that ECB essentially was much more hawkish than everybody thought they would be. Hinted at no further movement and certainly no possibility that they're going to do any type of LTRO or additional liquidity enhancements in the system, basically leaving the euro to its own devices. That created a little bit of short covering, pushed us through the 36s. Then the reaction today has been still mildly bullish euro, but as we look, if we look out a little bit further, we see the euro is really starting to run into some serious overhead. This big overhead of 3650, 3700, which was the big spikes essentially in the beginning of the year, and then pre-Christmas spikes, are all going to weigh, I think, on the pair. It's going to take a tremendous amount of positive news out of the Eurozone for us to really want to lift through these levels. Although that kind of a trade certainly would surprise the market and would create a lot more short covering and create a lot more pain on the trade. But I still see a tremendous amount of overhead here, and probably the more likely scenario is a failure here at around these levels as we come back. We're basically churning this 35-37 zone for the last month or so. If we look at, let's take a look at the 4-hour chart. You can really see how churning this trade has been. And you see that, in the 4-hour chart, basically since the start of the year, we had this liquidity spike in pre-Christmas or post-Christmas trade, but essentially since then it's been a slow distribution to the downside with a failure at each consecutive high. So presumably if this was the 38.50 high, this is the 37.50 high, this 36.50 high would be the next level of failure. That's what you would want to be betting on a longer term downtrend in the euro. I do think it's going to invite a lot of sellers if it comes up to this level. So euro looks mildly bid, but potentially a sell on the rallies, which means that if you look at the euro complex here, the one thing that kind of spikes out at you here is that if you look at euro yen, same kind of situation. You sort of have a series of really continuously lower highs, and this rally, of course, really faces pretty stiff resistance at this 140 level. Now, if it does come back and recover 140, then I think it does change the picture a lot, because it sort of creates more of a bottom out formation and creates a possible rally all the way through here as it tries to churn through all of this overhead resistance. But for now, even the euro yen trade, even though it looks quite good today, still looks like a sell on the rallies until these highs are violated. So essentially until 40.50 is violated to the upside, you have to believe that this is a sell on the rallies. Euro pound is the one trade that actually I think looks healthiest when you look on the complex. And one of the interesting things about it is that euro pound has clearly made a relatively decent higher double bottom here at this 82 level, and now we're just consolidating here between 83 and 83.50. This is really going to be, of course, a function far more of pound weakness, I think, than euro strength. And the story here is, of course, going to be next week, because we have Carney testifying with the inflation report. It'll be interesting to see if he tries to talk the currency down, or if he sort of shrugs it off and does pay homage to the fact that the UK economy has certainly been the best in the G7. The thing about pound that's kind of difficult, and we'll get to it in just a second, is I think the UK economy has reached peak growth, so every event forward is actually going to probably disappoint it a little bit on its value basis, which creates a natural downward pressure on the pound, which creates a natural upward pressure in this euro pound pair. So you have this 83.50 as the really big resist level, and a break above that really puts a much more bullish cast on the whole trade, and really puts the whole 85 level into play. So we'll see how that works out. Now, euro against the COM dollars is also kind of an interesting trade here. Euro Kiwi is just essentially a churn. Definitely still looks lower, but really needs to break the 62.50 level to really confirm a much steeper sell-off. It's kind of a non-event at this point and very, very hard to trade. Euro Aussie serve a similar situation. Needs to come down below this 50 level. 150 is the key support level. It needs to break that in order to really kind of confirm further downside action. Otherwise, it simply looks like it's making a double bottom here, and it could continue and could essentially be a trade up. As a matter of fact, one of the interesting looks here is I think a trade through 52.50, perhaps 52.75 or so, puts a much more bullish cast on the whole trade, and puts us towards the 53, 50, 54s. But still, it's a very churn and chop trade on euro and the COM dollars. And then euro against the CAD, also looks interesting because in a sense that it's basically this 49 50 zone for right now, and it certainly looks like it's bouncing off the bottoms. 49 seems to be really quite a lot of support here. We'll get to Dollar-CAD in a second, but this 49 support here, a break here is a pretty meaningful break that could potentially put us all the way down to 47. 51 to the top side puts us back to a retest of the 53s, but for now it's also sort of a burn and churn trade in the midst of nowhere. Now dollar yen also had an interesting trade today. So we had this knee-jerk spike down on the NFPs, and of course, is what you see. What's interesting about the dollar yen is that we have a series of higher lows here, suggesting that perhaps we're finding a bottom here. And this is all, I think, telling to the fact that the market feels a little more confident about the U.S. economy, feels more confident about taper, more confident about U.S. rates, and definitely finding value in this 101, 102 level. Having said that, though, it doesn't necessarily mean that we have a roaring rally. We essentially could have a consolidated phase here where 103, 103.50 is going to be the big caps to the trade. Even the 102.50 still acts right now as a pretty serious cap. So we need further positive U.S. economic data to really push us forward. Otherwise, it's just kind of a churn and burn trade in dollar yen. With the pound staged a pretty decent rally actually today off of the 63, 62.50 level. Definitely a key support. It looks like it's a double bottom in place here, but it's also, I think, a lower end of this range, which is effectively, if you sort of want to give yourself wide berth, a 65, 60, 62.50 range where we're kind of churning and burning around these levels. And as we get to the 64.50s, 65s, the level of resistance is going to be much harder. Now, if Carney comes out and is uber hawkish and even suggests that yes, maybe time has come for the BOE to consider rate hikes, this completely different story. We could have a potential of a blast off. Watching this blast off through 65 will then open up a full challenge to the 66.50 level, a complete change of direction, change of momentum. But if we still have a very cautious, very dovish monetary policy out of the BOE, it really puts a cap on any kind of rally here in cable. And as a matter of fact, if he tries to talk it down, we could have another retest of the 62.50 in cable. So worth watching. Bottom line is, I think it's pretty much going to be in the policymakers' hands as far as the price action goes. And you can see that technically the price action is just waiting to get a cue as it continues to channel. Now, cable over the crosses also looks. One interesting thing is sort of the cable Swiss continues to kind of drift lower here and kind of test this 47. We've tested the 47 several times over the last week and a half. And of course, a break of the 46s, I think, creates a steeper sell-off potential with a move towards the 44s. So I'd be watching this level pretty carefully for any cable weakness. Cable yen, a little bit better story because yen is just simply giving a big recovery. And of course, cable here is starting to really recover through the 67s, but again, it's now facing the 70-69 overhead resist, which could come both from the yen side and from the cable side. So it looks in many ways, when you're looking at the cable and euro, as a reflexive rally with sell the tops type of position. Although the dangerous part of that kind of strategy, of course, is you could really get short, flat-footed if there's, in fact, a significant shift of sentiment. If there's something in the market that convinces the market that this rally is for real instead of just simply a short covering rally. So, given as it is, I think these levels are probably relatively decent risk levels to sell at, but you got to be very careful not to let them go beyond that, because otherwise you're talking about a completely different construct. Now, Aussie definitely has put in a pretty decent recovery bottom. We've talked about the fact that 86.50 has pretty much signaled to us a bottom, and Aussie has certainly put a big formation here. What's going to be very critical for Aussie this week, from a fundamental point of view, is going to be the Australian employment sales. It's Australian employment report. If Australian employment just prints positive, it really doesn't even have to print massively positive. It just prints positive, just does not have a shockingly negative print. It just simply adds to this notion of the fact that the RBA is now neutral, not dovish, no more rate cuts. Aussie no longer simply the punching bag of the currency market, and puts certainly 90, 90, 50, and perhaps even on a really strong number all the way out to 91 in view. If we want to look back on a dailies, we see that this is obviously a key resist level, but as we come through, we sort of come into this big 90-91 channel. If we can overcome it, it really creates a much more powerful, stronger base for potential rally all the way back up to 94.95. So Aussie definitely worth watching as a potential breakout trade here, certainly above this all this choppiness around 91. And a move back, let's say a week report, will be a great test of these lows, and to see how well these lows hold, and see if the market is willing to be a buyer ahead of these lows. So that's going to be the look in Aussie as we go forward. Aussie Kiwi certainly has bounced off the lows as well, but Aussie Kiwi here definitely facing a big resistance at the 110 level, and I think even a really strong employment report may put a cap on this rally against Aussie Kiwi, because the market then will simply begin factoring in the Kiwi interest rate hikes, which will of course add to the spread differential between the two pairs. A positive move in the Aussie Kiwi, however, may be a really interesting look for the Aussie yen, because Aussie yen is reflecting this bottoming out formation in the Aussie dollar, similar carry trades. And again here, this 92.50, 93, the big resistance levels that we can overcome, pushes us towards a potential run towards 95s. So Aussie's shaping up to be a kind of an interesting trade from all angles. And then Dollar-CAD, let's just take a look at that, because that had big news. We had really strong employment data. What's troubling for loony bulls, and this is typically, of course, I think of CAD trade in general, the fact that we had very decent employment data, good halfway, not great, but certainly not horrid data out of North America, out of the U.S., basically connoting that the North American complex not doing that as badly as the market may have thought. The fact that we still could not close below the 110, that there was just massive amount of buyers underneath we tested the 110s and the buyers brought it back up, is kind of an interesting but also perhaps troubling sign for Aussie bulls, because for CAD bulls, because that would suggest that there's still tremendous amount of negative sentiment against the loonie, that anything underneath 110 is going to be bought rather than sold, that this breakout still holds for the time being, rather than just a peak formation at 112. So we really need to see, as a matter of fact, really at this point, a negative Dollar-CAD trade would have to break 109.50 in order to come back down to this 109, 108.50, which was the initial breakout level, and essentially take out all of these late longs that are still relatively dominant in a trade. To the top side, if this is a true sort of peak bottom here in the CAD, and CAD begins to move up, we of course have this 112 as the key level. The break here puts us on fresh highs, possibly to 115. That would suggest, of course, further loonie weakness. But for now, it really feels like loonie deserves a little bit more of a correction. So I would be watching this 111, 109.50 range and seeing how well it's trading. A break above here certainly would embolden the bulls. A break below to 109.50 would create enough of a stop run, and I think it could take us down to 109, 108.50 on a pure liquidation basis. That's kind of how the week shapes up. Not too much event risk on the calendar. We do have Janet Yellen testifying. We have the Australian labor data. Those are the two major points that everybody should be looking at. And of course, we'll have to see how the markets continue to reassess the European and the U.S. prospects going forward. Wishing you guys the best of luck, best of trading. Boris Schlossberg over and out.